Hi everyone, today I want to share exactly how I invest my own money and how my strategy has changed over the years. Back then when I started working and saving a little bit of money, the only investment I knew was real estate, buy a condo or a house. I was so obsessed with saving for a down payment, which felt so frustrating because you need a big lump sum to be able to put a down payment on a property. That means you need to save years and years before you can start investing. I didn't know any better back then, and that's also what I hear from everyone. Real estate is the best investment until I started to learn about the stock market. My very first investment was with Cole Financial back home in the Philippines. This was years ago. I remember I was so excited because now I can invest with small amount. So I invested in Philippine stocks and it felt like the ultimate grown-up move. Tracking prices every morning, trying to pick the next big winner, and imagining my money doubling overnight. But when I moved to the UK for better work and better opportunities and a fresh start, it's honestly been difficult to manage my Philippine stocks. The time zone difference alone is exhausting. The Philippine Stock Exchange opens when either I'm working or asleep. And to be honest, most of the stocks I bought have never fully recovered, especially after the COVID crash. And that's not to say that the Philippine stocks are not good investments. I must have picked some of the wrong stocks, which is perfectly normal in investing. You win some, you lose some. But it also forced me to rethink how I build wealth. I wanted something stable and easier to manage. These days, most of my Philippine pesos are invested in Pag-IBIG MP2 and Cooperatives. Simple but stable tools that still grows my money back home while I'm working abroad. And because I'm now based in the UK with access to global markets and digital investment platforms that I can invest with the tap on my phone, the bulk of my portfolio today is made up of exchange-traded funds and index funds, which is a stress-free, proven way to build wealth from the stock market. One thing I've learned, and trust me, I learned it the hard way, is that investing isn't about being the smartest person in the room. Doing well with money has little to do with how smart you are and a lot to do with how you behave. For me, that means one thing: keep it simple, automated, consistent, and boring, because boring actually works. So here's exactly what I do, how much I put in each one, and why I chose them, and how they all work together. You'll see that you don't need to overcomplicate things for your money to grow. Here's how my investment portfolio look like today, excluding real estate. Here's the breakdown, starting with 10% Pag-IBIG MP2, my safe savings back home. In my view, this gives me stability, steady growth, and peace of mind. MP2 is the Philippines government-modified Pag-IBIG savings program. It's tax-free and it pays annual dividends, 6 to 7% historically. It's a perfect place to grow my Philippine pesos safely, and it's not volatile like the stock market, and it's super easy to top up online, even when I'm in the UK. I treat MP2 like my safe bucket. It's not meant to beat the market. It's meant to keep my pets working harder than they would in a regular bank account. Now, 12% of my portfolio are savings in cooperatives, my community-based investments. Cooperatives are my second layer. I'm a member of a trusted multi-purpose cooperative in my hometown. They take members' savings and lend them out or invest in businesses that benefit the local community. The big win is the annual dividends, usually 8 to 11%, which is excellent for a stable community-driven investment. One downside for me as an OFW, I don't get the full benefit of patronage refunds. Patronage refunds are bonuses that you get if you actually use the co-op services or buy their products, like taking out a loan, buying groceries, or other products. Since I live abroad, I don't use a lot of those, so my return is mostly just dividends. But I still love the idea that my money helps local families while earning a good return. Now, my global stock market investments are in ETFs and index funds. I call them my growth engine. And that's 75% of my total portfolio. ETFs that simply track the market indices like S&P 500, the FTSE 100, and the Vanguard World Indices. With index funds, I own a piece or hundreds or even thousands of companies from Apple and Amazon to Toyota and Nestle. So I'm never betting on just one winner. Because I'm in the UK, I have access to global platforms with zero fees. And since it allows fractional shares, I can invest straight from my phone, even with as little as £50. These are self-managed portfolio and therefore no advisors or portfolio managers taking a huge cut. I love that index funds have rock bottom fees. Some are as low as 0.07 compared to actively mutual funds that they charge at least 2% per year. With index funds, there is no guessing. No day trading, no time zone stress. I just buy the whole market, automate it, and forget about it. Lastly, 3% of my portfolio is on speculative investments, my tiny fun money for high-risk bets. Let's be real, we're all humans. We all want a piece of the next big thing. That's why I keep 3% of my portfolio for speculative plays like individual stocks, crypto or stable coins, or even the occasional startup idea. This is my risk taker side, but it's small enough that if I lose it all, it won't hurt my real plan. Now, you might be wondering, is the stock market really worth it? Well, let's look at the numbers. Index fund has historically returned double-digit returns on average. S&P 500 recent 3-year return is 63.92%, 26.3% in 2023, and 25% in 2024. So far this year, 2025 year to date, it's up about 7% as of mid-July. At the time of recording, the index currently sits around 6,250 and it's projected to soar into 10,000 mark by 2030. And that is why I stay in the market, because I know that over time, it grows. Some years are bad, but the long-term trend has been always up. We're talking about 100 years of history. And why I prefer index fund over mutual fund? Because of fees. Fees can quietly drain your future's wealth. Here's a simple example. If you invest $100,000 for 30 years with an average return of 8%, my money grows to over $1 million. And with 0.07 index fund fee and zero platform fees, total fees over 30 years is about $19,000. But if you compare that with mutual funds charging you 2% management fee, you are left with just $574,000. That's over $430,000 gone, not because of the market, but because you paid too much for someone else to manage your money. This is why I prefer index funds and ETFs over traditional mutual funds. The fees are low and you keep more of what's yours. And here's what it ties together. I automate everything. I treat investments like a bill I pay for my future self, then get on with my life. I'm not checking stock prices every day. I'm not worried about time zones or chasing the next big company winner. I set and forget my portfolio, and that's what gives me peace of mind. Warren Buffett, one of the greatest investors of all time, did not become multi-billionaire overnight. He started investing at age 11 and achieved his first million at age 30. And only when he was over 60 years old that he became a multi-billionaire. That's about 20 years to earn the first million and another 25 years to become a billionaire. Now he is worth $137 billion. Buffett's net worth trajectory is a testament to starting early but staying invested for a long time, which is the real secret to investing. That's how you take advantage of the power of compounding. But how does compounding really work? Let's have another look at another billionaire example. Manuel Villar, now the richest man in the Philippines. He started a business delivering gravel and sand for construction companies. His initial capital was only 10,000 pesos. He became billionaire in 2014, but now his net worth is 17 billion. That's 1,000% increase in his net worth in just 10 years. That's the power of compounding. If we can learn and take one thing from these billionaire stories, let it be this. Growing wealth takes time. It's a test of endurance. It's about how long you're invested in the market. That's why I keep investing. But I keep it simple, balanced, not complicated. My portfolio is designed to keep growing wealth with time. so that I can focus on what really matters. See you in the next video.